Hello and welcome. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. Stocks can make long-term profit growth visible, and also to detect other things which should be of interest for you if you are going to invest or think about investing in a special stock. For example, looking at McDonald's. McDonald's lost revenues of more than 7 billion within the last years. And if you're interested in McDonald's but don't know why this happened, then you have a lack of knowledge in this regard, which is not a bad thing because you are watching the video right now, but it's just an example that often people invest in stocks and there are happening things with the companies. They are in transitions and people even don't know that this is happening, and they just look, for example, on dividend related metrics like how many years the dividend already increased and so on. So we look at McDonald's right now and we will answer, I think, the most hottest questions many people I guess don't know. So let's go. I think that even if you don't know why McDonald's lost 7 billion revenues in the last years, you still know the symbol of McDonald's, which is MCD. Here it is. And first we look at some key metrics of McDonald's. Superficial way to evaluate a stock, but it's both superficial and efficient because it goes very fast. So we have the more than 40 years of dividend increase. We have payout ratios which are still okay, and dividend yield of 2.2%, bolstered by dividend increases between 7 and 8% within the last years, and dividend stability, which is extremely high. It's 0.99. The maximum value is 1, so it means that the dividend increase is very predictable. Even more important, because dividends are based on profits, earnings, is the earning stability and the stability of the operating cash flow, which is also extremely high. I enlarge the screen here. It's extremely high with 0.96 and 0.97. We also have increases here. Earnings increase by around 11% even within the last 5 years average, the yearly average operating cash flow with nearly 8%. Then let's go on. Then we look at the revenues, total sales, and we see that the stability drops 0.7, which is still not really bad, but it's worse than the very nice stability matrix here with earnings and cash flows. And then we see that the increase of the last 5 years is less than or 6% decrease, and we have to explain this, and we do it very fast or very soon. And here you see the long-term performance of the stock regarding capital gain. So McDonald's was a good investment if you kept the stock just long enough. Let's go or have a look more in detail, and then we see something which is very interesting. Maybe first here the per share matrix, which show you that McDonald's by per share matrix was a very successful company so far and probably continues to be. We have nice increasing earnings and operating cash flows. We even could take off the zoom. Then you see the increase rates. Let's go on, because I think my picture is on the left bottom. Here now you see everything. You can see the fundamentals starting in the 80s, and you see that we have nice increases here. For example, in 89 the dividends were 8 US cents, and today, the last 12 trading months, you get $4.34, and earnings per share was less than $0.50, and today it's $7.54. So nice increase. On the one hand, if you look at the total on the global level of the company as a whole, not on the per share matrix, then we see that the revenues steadily increased. We always had difficult times for McDonald's as well. Each company faces different difficult times from time to time. For example, at the beginning of the millennium, there was a crisis. You can also see it here. It translated in operating margins, which were dropping. And then here in 2014, 2015, let's zoom in a little. McDonald's also faced hardships and the CEO changed, but then everything went back to normal. And now we have these decreasing revenues from starting in 2014. So revenue drop is in 2013 we had more than 28 billion revenues, and today it's about 21 billion. So 7 billion revenues lost on the one hand. On the other hand, we see that the operating margins increase considerably from 29 to 41% today. So there's a contradictory development, and we need to explain this if you want to understand McDonald's as a company today. I always repeat myself saying that stock screener can't tell you everything about a company. No stock screener can this, but stock screeners can show you where to dig deeper. And if you just look at this chart, you see that we need to dig deeper. Digging deeper, I did, looking at the annual report, for example, of 2018. And to explain you what happened in the last years of McDonald's, we need to look at McDonald's as a franchise operator. And we see that McDonald's had about or has about 38,000 restaurants worldwide. And there are two types of modes. It's one mode is the traditional mode, operating mode of the restaurants, where McDonald's is both operator and owner of the restaurant. And then we have this franchise model. This is a typical model. Overall, about more than 90%, 92.7%, Excel just told me, of restaurants are operated in franchise mode. And franchise mode is the most profitable mode with the highest margins. We can see it here for McDonald's. And the traditional mode is the mode with the lowest margins for McDonald's. And just to explain the different types of franchise, the franchisee always pays a license fee or royalties to McDonald's. It's this kind of data. And sometimes the owner of the restaurant can either be McDonald's or the operator, franchisee. If McDonald's is the owner, McDonald's additionally collects rent. And this means that overall the margin is the highest. And luckily for McDonald's, this kind of franchise mode is the franchise mode encountered the most often. 57% of restaurants operate in this kind of franchise mode, but the franchisee can also be the owner of the restaurant, and then McDonald's does not collect a rent at all. It's about 20% of restaurants operating in such a mode. And then there's a kind of joint venture between franchisee and operator, franchisee and McDonald's. For example, in China, this happens very often. Often in China, companies are not allowed to own 100% of the complete company. And so we have this mixed mode here where margins are lower than in the other two types of franchise mode, but still higher than in traditional franchise mode. And McDonald's made a change, which is still going on. They reduce the number of traditionally operated restaurants with lowest margins, and they add these restaurants to the franchise mode. And this explains why the revenues on the company level drop, because if restaurants operate in traditional mode, then 100% of revenues are McDonald's revenues. And if the restaurants is operated in a franchise mode, then the revenues are the revenues of the franchisee, but not of McDonald's anymore. So the revenues of the company, of McDonald's, drop. And this drop will probably continue because they will lower this rate here to about 5%, which means that in traditional mode, at the end, McDonald's will still operate about 2,000 restaurants. They will keep some, although margins are the lowest because of our reasoning. For example, I guess that they can easily test new things if they are the owner, or if they are both the owner and the operator of the restaurants, without requiring the franchisee to cooperate with them. And they are very close to the market and they know what's going on. So there are still reasons to keep some restaurants in the traditional mode. That's the explanation for these superficially contradictory evolution here of shrinking revenues and increasing margins. Then I took another look at the regions, because I wanted to know, for example, if the pending trade war between the United States and China may have an impact, to get just an idea. And we see that the most restaurants, or the most revenue, is coming from the United States, and that there's also the highest overall income in the United States. 36 or 37% of the revenues are accounting for 45% of the overall operating income, which means that the customer in the United States is traditionally the best cash cow for most companies. That's true for McDonald's, that's true for Facebook, for example, as well. We have international lead markets, for example, where Germany takes part, and it's about the same revenue, slightly below, but the operating income is well below the operating income from the United States. Then we have the high growth markets, where, for example, China takes part, and the operating income is only 11% of the overall income of McDonald's. And I wasn't able to spot how the share of China in the high growth markets, but I think it's rather low if the overall segment accounts only for 11% of the operating income. And then don't forget that, as I said, in China we have this mixed mode, this mixed franchise mode. This means that if there is a boycott, then Chinese people also boycott Chinese businessmen, which are also owning part of the restaurant. So I think the pending trade war won't be too hard or break the neck of McDonald's. Just some more words about McDonald's in general, which are the keys of the success. I think that's the efficiency by standardization. They have a very popular brand, and they have real estate in the best locations. That's I think the most valuable assets of the company. Then let's continue here. I want to show you some other things. We need to go into the full chart analysis. Let's look at the substance at the balance sheet of McDonald's. If we do so, we see that the treasury stocks here are very high. If you take a look at the balance of McDonald's from a real accountant's perspective, it looks like this. These are all the assets of the company. And two things we note of interest. First, we have shrinking total assets from 2015 to 2016-17. This needs to be explained, and then we have an increase of total assets from 2018 to 2019, which needs an explanation too. Looking at the total debts, we see that on the one hand here, from 2015 to 2016, overall debt, total liabilities increased, but the assets decreased. And the explanation is treasury stocks. You see that if we add the treasury stocks, the shares repurchased, to the assets, and there it's from an accountancy perspective it's wrong, but from an economic perspective I think it's right, not only because it explains what happens here very easily, but because treasury stocks are, to me, a kind of asset the company can work with if they are not retired, and McDonald's does not retire the shares they repurchased. But we can see here that the treasury stocks increased and that there's a decrease in cash. No wonder, because it's a transformation from cash to treasury stocks, which happened here. And this is probably due to sales of, let's go back to Excel, of restaurants, which were going from the traditional mode to the franchise mode, when their operator is the owner, one of these two modes here. And this explains the drop of the total assets here. And then here we have an increase in both in debt and assets as well. And I was looking at this, and to me it's mostly an accountancy issue, a technical accountancy issue. And here we have the impact of the ASC 842 on real estate and restaurant sector. I'm not going into detail what happened here. I just want to show you that it's a technical issue here, which leads to this accountancy change in my point of view. What's also interesting is that we always have share repurchases. Here we have the high level. You see the high level of repurchased shares, which is even above or higher than the overall assets of the company. And we have here the repurchase ratio. It's this black line, and you can see that the number of outstanding shares is always decreasing. Here we have a decrease of outstanding shares of nearly 9%, which was exactly between the repurchase which happened between here and here, 2015 to 2016. And of course, a strong repurchase increases or makes the per share matrix look better. And we have here, for example, in 2016, then adjusted earnings per share of less than $5, but thanks to repurchases nearly $5.50. But that's not something you should be overly worried about, because we can see that McDonald's is a highly profitable company. And if you add if you look at the amortization power and compare it just with total debts, then we see that okay, McDonald's need more than about close to 50 years to pay back its debt. It's very much, but they have real estate which becomes more and more valuable, and they're a very stable business, so you don't need to worry about the debt level. At least I don't worry about the debt level. Then you'll have to look at the valuation of the company, I think. And these are exactly the two charts you will see below. We can either start by the dividend yield. Many people take this approach. Let's take this approach as well. And we go into the dividend turbo. And the dividend turbo gives you an idea about the current dividend yield compared to the historic dividend yield, which means is the current dividend yield high or low compared to the past. So let's have a look at McDonald's. We already know that the current dividend yield is 2.2%. And now we see that within the last years, the dividend yield was above 2.2%. It was as high as 4.1% even sometimes, and now it's rather low. So we see that the dividend yield from an historic point of view is not that attractive. And we have dividend increases, forecasted dividend increases, but even in 2021, your dividend yield won't exceed 2.7%, which is still low. And this is regarding the past. So this already an indicator that the valuation of the stock is rather high, the current valuation. And now let's look at the multiples, comparing historic multiples to current multiples of the stock. And we see that McDonald's currently trades with a P ratio of 26 and a PC ratio, not taking the earnings but replacing earnings by operating cash flow, of 21, which is rather high for a stock like McDonald's. And we can also see that it's rather high by comparing it with the last 10 years. Then the historic averages of the multiples were 20 for the earnings and 15 for the operating cash flow. So it's rather expensive, the stock right now. And it's also the same conclusion if we look at the fair values, which are calculated based on these multiples. And we have a fair value of the stock between 140 and 150 US dollar. Current stock price is close to 200 US dollar, and it means that we'll have to wait several years until in 21 the fair value reaches the current stock price. You can argue now that McDonald's is a better company than it was before, because here of growing margins, because of this transformation I tried to explain to you, which happened here. And then you are free to calculate your own multiples, you will say, which are justified. And then maybe you can get other fair values. It's not that complicated to do. You just say, for example, that the fair value is not 20 but 25, and then you're already very close to the fair value here. It depends on you, but based on the history of the last 10 years, we have a clear overvaluation of the stock. I try to give you an idea about McDonald's, what happened to the 7 billions they lost in total sales, about the evaluation. Thanks for watching. See you next time. Bye bye.